Hey, good to be back. Improving your trade selection with pattern and direction. That's the topic. We may veer off a little bit. We'll cover gold today. We'll cover what's going on in the other markets. It's so important as to when you have a big event in one market, you need to know that, because that's definitely going to influence the other markets. You know, correlations are so important in markets. Markets, they're just like people. You know, they definitely interact with each other. You definitely have alpha markets. You have leaders. You have laggards. So you definitely have to understand those relationships. They're important. Today's topic, though, improve your trade selection and with pattern and direction. Good stuff there. As always, we need to remind you trading involves risk of loss and is not suitable for everybody. I think you guys know that, right? You can lose in trading. Additionally, the techs I demonstrate are proprietary and should not be retaught or retransmitted for any reason. My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade. Good to be here. I've written a couple of books on trading, or a few books, actually. The first couple of books I wrote were published by McGraw-Hill. Here's the second book on the right is the technique we're going to talk about today as far as determining direction in any market on any time frame. That's covered in that book. What makes both these books unique in the industry is that they have trading plans in them that that provide essentially a roadmap to follow. You need a trading plan in trading, so we're proud of that. You have the trading plans in there. You can go ahead, look them up, back test them. That's good stuff. You absolutely have to have a plan, and you need to be upfront with that, especially in this business. Mr. CC, I am a 33-year-old veteran. Very good, very good. Here's our third book, The Secret to Trading. Very proud of this book. It's a heavy book. Really, it outlines our philosophy on trading, and more than that, it provides a framework for how we determine which market to trade and which direction to trade it from. So, very, very important. That you definitely need to know which what market to trade, and which direction to trade it from. That's for sure. Here's a link to that book if you want to take a look at it. This is a very important question, and one we don't cover at all at Trading University. We really focus on what does work for us. We focus on our methodology. We're not there to point out what people are doing wrong. That might take a long time, right? Because everyone has their own bad habits, and really that's their business. And I'll be honest, it's really not in my. It's really in nobody's interest to tell you what you're doing wrong, right? Unless they're relying on you. I mean, my clients, they rely on me. They pay me, right? They pay me to teach them, so I kind of owe that to them to get them on the right track. But honestly, no one's really going to, well, put it this way. If someone's telling you what you're doing right, if they're telling you what you're doing wrong, you got to tell them, hey, look, tell me what to do right, okay? Don't tell me what I'm doing wrong. Tell me what to do that needs to be right, right? So that's where the focus is. But given you're not my students, given you're not paying me, if I can do something to nudge you on that right path, that's fine. So I don't have a problem giving you something for nothing, right? So probably the two biggest reasons why retail traders do not succeed is they don't understand risk. You have to understand that you're risking your money to make more money. That's a tough dynamic for other people. Oh, sorry about that. Let me turn that Skype off there. You have to understand that it's up to you to risk your money to make more money. Most people, they're not ready for that. They're not ready to take that risk. They don't understand it. Most people, I've noticed, they'll tell you that they're going to risk $50 on a trade, and the minute they get down 35 or so, they're going to tell you that, well, well, they'll say they're going to risk 50 pips, but anytime they're down 35, they're going to jump out of that trade before they know what to do, right? So risk tolerance threshold theory just says that most people say they're willing to take a risk, but they're really not. So what this means is a lot of traders jump out of trades too soon. Okay, that's the bottom line. People exit their trades way too soon because they don't understand risk tolerance. Okay, risk tolerance is a fascinating subject for us. I mean, we've essentially come up with a theory based on it, and we see it playing out time and time and time again. How traders exit the trade prematurely, and that level that they happen to exit at oftentimes happens to be right on top of a Fibonacci number. Okay, so basically everyone has a price point. Everyone who has a position in the market has a price point where if it gets to that point, they're going to exit that trade. They may not want to exit that trade. They may realize it's a bad idea to exit that trade, but they can't take the risk, okay? When you're losing money, it's almost like your hand gets too close to the stove. When your hand gets too close to the stove, you don't tell yourself, well, I think I'll move my hand. No, you move your hand instinctively, right? Bam. Same thing in trading. When you're losing money, it feels so painful that you're not going to walk away. You're not going to say, well, I have my stop in place. I'm just going to walk away and not worry about this. I said I was going to risk 50 pips. I'm going to risk 50 pips. I'm going to go outside and get some fresh air. No. People don't react that. You know what they do? They grab their mouse and they exit that trade and they take a 40 pip loss. And guess what happens? The market goes down a couple pips further, turns around, goes right back in their direction for the next 3 days, right? If they would have just sat tight, they would have done pretty good, right? A lot of times they put their stops too close, too. They'll go, aha, here's a Fibonacci number. I'm going to put my stop right below it. Or here's a 50% retracement. I'm going to put my stop right below that retracement. Well, guess what happens? The markets always go a few pips beyond those levels, right? Because market makers know that. So most people lose money. The biggest reason most people lose money is people don't understand risk. So you have to understand that risk tolerance. Okay. The second biggest reason why people lose money is they don't understand the importance of using market-generated setups and signals. Here's what's so magical about, let's just say, here's what's so important about recognizing that I don't decide what level I'm going to buy at. The market decides what level I'm going to buy at. Okay. You have to understand that market-generated information is really the only information you need, okay? I call it believing what you see, okay? If there's one thing in life I've learned, I can believe what I see. I don't always believe what I hear. I can't always believe what I read, but I can believe what I see. And what I see is what the market shows me, okay? The pattern the market displays for me on the chart, I believe that so strongly because I know that when it comes to markets, the pattern you see on the chart is absolutely a reflection of underlying fundamentals, okay? So the pattern on the chart, the highs and lows we see on the chart are definitely a function, they're definitely reflective of the underlying fundamentals in that market, right? So what's so very important is that you understand that the market is going to provide the support or resistance. The market's going to provide the signal for you. Okay? Here's a classic example of a market-generated setup in the euro this morning. I'll show you where these lines came from. I'm going to take that low right there. I'm going to mark it. I'm going to trace it up to that high right there, the previous high, right? Okay. See that purple line, that green line, that creates a band of support. Now I know from past experience that this market, or that band of support, has a pretty good track record of giving me buy setups. Particularly there, I took the frame off so you can see I left the lines on there. This particular setup has a pretty good track record, particularly when you have the majority of patterns aligned. Here's the euro. We break the euro down into different patterns. It's the primary happens to be down, but the secondary is up. The long-term day-to-day is down, so is the short-term. But look at these micro patterns; they're all up there. So if you're a short-term trader and you trade from the daily down, if you look at the majority of patterns in this market happen to be up. There's another way we say the majority of patterns. That would be the collective pattern. So the collective short-term direction in the euro happens to be up. Okay. Again, this is all market-generated information. I didn't determine that this pattern is up, or this pattern is up, or this pattern is down. The market is telling me that over this time period, that market is either up or down. It's either black or white. So I take the majority of these patterns, and that becomes my collective pattern. So today, coming into the euro, the collective pattern happened to be up. So when I get down on down and dirty on a 5-minute chart, for example, or even a 15 would have worked too. I see that big triple bottom in that zone here. The 15-minute will give it to you a little better. When I see that triple bottom, I have a pretty good idea. Well, even coming in, I have a pretty good idea that these are the areas I want to concentrate on being a buyer. Okay. Now, again, that's what we call a market-generated setup and signal. I didn't make that determination. Literally, the market did. Here, if I go out to a longer-term chart, you can see how the market itself was telling me what to do. So I had the secondary up, and, well, that's really not giving you the whole picture. Here's the picture right there, where when I break the market down into different patterns, you can see that the majority of short-term patterns are up. Therefore, I'm focusing on the long side in the euro today. So what I'm saying is the market itself is determining that I'm going to be a buyer, okay? I'm not making that determination. It's the market. So understand the importance of market-generated setups and signals, okay? There's no doubt about it. Markets are fractal-based, and when you break down those different fractals, they're really going to give you the direction you should be trading in. How is it that info you just posted generated? How do I get it? Good. That's a great question, Kevin. We actually email that to all our clients from time to time. Our course is essentially free also, and we'll get to that. Yeah, Kevin, you definitely need to know how to do that. The book will explain it too. Risk Tolerance Threshold Theory explains basically exactly how we do that. The numbers, we don't necessarily give we'll give you the proprietary numbers in the class. We just use Fibonacci numbers in the book, but the book is spot on too. If you haven't figured it out, we're big on method. I'm big on method. I know what I'm doing every step of the way when it comes to trading. There's really nothing left to chance. I'm just there to execute. My job is just to be able to sit on that screen and focus for 4, 6, 8 hours and recognize when that signal's there. I'm there to execute. I'm not there to think. All the decisions are made for me, okay? I'm just following the trading plan. The market itself plays the music, and I just try to dance to it. So you have to have a method. There's no doubt about it, you have to have a method. And that method also better be easily explained. And it better be simple. Well, at least it better be simple for you to understand, okay? If someone's teaching you how to trade, you need to be able to say, well, hey, what studies is the method based on? Do you use market-generated setups and signals? Do you use time-based triggers? Time-based trigger, very important, because if you say I'm going to take a signal on a 15-minute chart, it needs to be on the close of the 15-minute candle, right? Because a moving average can cross and uncross multiple times over the course of a 15-minute candle. So you need to know that you're using what we call a fact-based trigger, meaning you're taking the trigger on the close of the candle, right? Because when you look at past charts, you backtest, all you're seeing is the result of a closed candle. You need to understand if you're trading live that are you taking a signal on a closed candle or not? Because a moving average can cross and uncross. A stochastic can cross and uncross over the life of a candle. You need to know all these things ahead of time. So these are the questions you need to ask people that are teaching you how to trade. And they better be able to rattle off that answer immediately. In other words, they better see it as simple, and they better be able to easily explain that to you. Before you start trading live, you need to know how simple it is, and you need to be able to explain it pretty easy. You are terrific. Thank you, Kevin. I don't know what other people base their stuff on. I don't care, because it's been so long. I had Bill Williams as a trading mentor. Bill Williams is a fantastic trader. He takes a little too much risk. I prefer a method that has a higher winning percentage, but I was trained by winners, So I can't speak what other people do, but we'll just stay on point there. But thank you very much, Kevin. What has to be very, very important in a method, and we'll cover method real quickly, we'll get through this very quickly, is you need both a mechanical framework, and that's what we provide in the book. In the book, we give you a mechanical framework to determine which market to trade and which direction to trade it from. It has to be mechanical, meaning it has to be black and white, and it has to be the same every time. There's no doubt about it. It has to be the same every time. Okay? It has to, 1 plus 1 has to equal 2 every time. 2 plus 2 has to equal 4 every time. Okay? You need that mechanical aspect because you got to rely on that. At the same time, though, you do need to have behavioral aspects, particularly for trade management, and particularly if you're going to trade through the news cycle. Okay? You have to know how to manage a trade. You need multiple contracts, so you may exit I exit my first contract automatically. That's mechanical. I know based on where my stop is. If I'm going to risk, if I have a 12 pip stop, then I'm generally going to look for an 18 pip profit, and that's automatic. So I put 2 on. If the stop is 12 pips, I take 1 off at an 18 pip profit, and then I manage the second contract based on momentum generally. So when you're going to manage something on momentum, that's a behavioral aspect. It's not mechanical because it's up to the market itself. The momentum of the market will determine where I exit my second contract. That's behavioral. My first exit may be mechanical. My second one is generally going to be behavioral. So to me, and I've been doing this a long, long time, the best way to go about this is you combine that mechanical, which is always the same, 2 plus 2 equals 4, and then the behavioral, you rely on momentum. You also need to know when numbers are coming out. You definitely need to keep an eye on your FX Street calendar because you don't want to trade ahead of numbers, right? You don't want to trade ahead of Boss Draghi when he's got something to say. So, there's behavioral concerns. No doubt about it, when gold was falling through the roof, gold collapsed on Friday, so I came in Sunday night, Monday, even though the patterns were still bullish in the Australian dollar, and I'm bullish long term on the Australian dollar, I knew that gold had collapsed, so I knew that Monday you were going to see some margin calls blowing through that Aussie, so I had to back off on that. The behavioral aspects are, that's how you master it, but how you get confidence, how you get good is have the mechanical framework down pat. You have to also acknowledge the different time frame patterns in a market, okay? And the first 3 are straight out of the Dow Theory. One of the best books I've read on trading, The Dow Theory, was written over 80 years ago. It wasn't written by Charles Dow, technically. Charles Dow lived over 100 years ago. It was written by one of his understudies, 10, 15 years after Charles Dow put forth his theories in his newspaper, the Dow Jones Industrial Average, right? I'm sorry, the Wall Street Journal. My bad, Dow Publishing. They're still around. So the time frame patterns, the first 3 are straight out of Dow Theory, and of course they didn't have intraday charts back then. So then there's your 20-day micro, your 10-day micro. So you take these 5 patterns. These are going to be essentially your tradable patterns. So Kevin, you had asked where do you get that information? It's right here. We tabulate that ourselves, and that's based on time. Some of our students, a couple of students, they're pretty sharp. They're engineers. One of them, Kelly, is actually automating this. He's in the process of automating that. I don't really need it automated. I can kind of see it with the naked eye, and I just like to do it. I only cover a handful of markets. I cover maybe 3 markets at the most that I'm going to trade, but I follow 5 or 6, so I have choices. Trade the best one. Yeah, this will be cool when it's automated. He's gonna automate it in MT4, and he's looking for users to bang on it, but I don't need it myself. That would kind of, then I have to check the mechanics. So I just do things in my head, and that's just how I am. I mean, it'd be hard for me to mechanize it because I'm completely right-brained. By the way, I'm more artist than mechanic. But I work well with, I love having engineers for clients. I work well with people that everything's black and white in numbers. I love when you can break it down into numbers. But you have to acknowledge the different patterns in the market. There's no doubt about it. Big on method for sure. Here's the method that we're going to talk about for the most part. This would be our long-term method. We focus on markets with low non-systemic risk, i.e. currency markets, and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. That's the key. Let me back it up. When that day-to-day is aligned with either one of these, or even better yet, both of those higher time frames, that's when you're going to get the biggest trades, when those higher time frame patterns are aligned. So I'll give you some examples of that. Here's the euro. This is an old chart. We'll get to the live charts too. This is an old chart, but it makes the point that this is beautiful. The day-to-day happened to shift down here. So in March we were selling rallies in the euro. The tail end last year, the day-to-day was higher in line with the secondary pattern, so we were buying dips in the euro. Currently, the euro is actually balanced up, but the short-term patterns give you the edge. In a balanced market or in a counter-trending market, the short-term patterns determine the direction. In a trending market, the higher time frame patterns determine the direction. So an advantage of trading with the day-to-day in line with either the primary or secondary is, you're buying dips on the way up, you're selling rallies on the way down. We are not temperamental. We'll trade either side of the market. The bottom line in trading is make money. Okay, it's not to be in agreement with the economist. We don't trade the moral high ground. We don't question the right or wrong of Mario Draghi's policies. We don't argue with Chairman Bernanke. We're here to just stay on the right side of the market. From our perspective, there is only one side of the market to be on, and that is the right side of the market. Oh, Black Cat. See, yeah, you may be more mechanically minded, Black Cat. Yeah, I used to do that. Now I have so much confidence. I can pretty much eyeball it. I don't count candles, Black Cat, as so much. Here, I look at the move. I look at the move. I mean, I can go back with the naked eye and I count months too. Like here at the 4-hour chart, like that's 10. To me, this is my 10-day pattern. Basically, it's a little longer than 10 days, but 10 days, 10. So that's my 10-day pattern. So clearly, that's bullish, right? You just actually took out your short-term day-to-day. It took out this guy here. That pattern, that just shifted bullish. So, yeah, it's looking good, man. But the euro was balanced coming as early as last Wednesday. Whoops. As early as last Wednesday, the short-term guys were going long. And I had to update it. But you can see now, when you count that 5-day pattern, the majority of patterns are bullish. This guy, by the way, on the 4-hour candle, that's gone now. It shifted bullish. But I had a short-term, a day-to-day, a long-term day-to-day, and a short-term day-to-day. Now I'm just down to one day-to-day. So this pattern just got even more bullish, right? That's what I was saying in the Black Cat. I think you get the weekly report every week, right? We mail it to you. And that's why I was saying, hey, you know what? You got some upside going. So, man, we were talking Sunday. We were talking Saturday before the markets even opened that, we suspected that you have some upside. But Black Cat, I feel for you because a lot of our students, too, that they get caught up in counting candles like that. And I'm much more spatial. I see the big picture. I have a lot more confidence in it because I have a lot more experience in it, too. So here's an example of you trading the day-to-day with the primary pattern. Here's another example of trading the day-to-day in line with the secondary pattern. Here, both the secondary and the primary were up. So this is dollar-yen. So right here, that's kind of a layup. This looks fantastic. This was not easy to trade because it blasted off. I happened to be up at midnight when that occurred. So, you're able to get in closer to 94 here. But that was not an easy trade. You either were there or you weren't, and it was gone if you weren't. So that was more difficult than it looked. However, look where it stopped. Right on that risk tolerance threshold level. You could never close below it. You didn't get two closes below it, so that line held. So this pattern stayed bullish, basically. That from there to there. That was a 20-day pattern, by the way. The 10-day was down. So your risk tolerance threshold, well, I'll show it to you, because otherwise I'll never get through all the slides. But your 10-day was down here, but the 20-day was up. So the day-to-day, the 20-day, the day-to-day, secondary, they were all up. So if you have the majority of patterns up, it doesn't even matter what the short-term ones are doing, because remember, in a trending market, the higher time frames exert the most influence. In a balanced market or a counter-trending market, the short-term patterns are going to exert more influence. And here's how we trade short-term. We look to trade at those times when the micro patterns are aligned with the day-to-day news flow, and make sure we trade around the intraday news releases. You have to wait out those news releases if you're a short-term trader. I tell you what, there's a huge advantage though of taking those micro patterns in line with the day-to-day. But you have to know the news. You don't want to step in front of anything. Here's a great example. The day-to-day pattern was down. This is gold. The day-to-day pattern was down forever in gold. So gold it's somewhat surprising how fast and hard it dropped, but it shouldn't have been surprising that it did drop. The day-to-day pattern was down. So here's what we mean those micro shifts. Here's a micro shift. It's that simple. Determine the day-to-day pattern. It happened to be in line with the secondary pattern, by the way. So the day-to-day and secondary were down. That's like cheating, believe me. Draw the bull trend line. When the counter trend line gives way, get short. There's an example of intraday when the micro time frames shift in line with that day-to-day, which happened to already be in line with the secondary. And here's in the Aussie dollar. That was back in March. You had the day-to-day pattern had actually shifted lower in the Aussie, so we were actually working the short side in the Aussie. And there you can see the day-to-day pattern pretty clearly from the channel lines, and then you're just taking these micro shifts. Bam, bam. Draw counter trend line. When it breaks, get short. That's an example of the importance of that day-to-day. Here's one of really just a great guy. I'm trying to determine if he's my first or he was my first off the trading floor mentor. He's my first on-screen mentor, Bill Williams. Great guy. Still trades every day. 81 years old. 81 years old. He's been trading 53 years, he said, I believe. But still trades every day. He said, a great quote, in this early part of the 21st century, we have a choice to either be a part of the last generation of traders and investors using linear, ineffective techniques, or the first generation using effective, nonlinear, chaotic techniques. That hit home. When he said that, I knew he was right. And I knew that I had to see what he was about. And I think what we've taken what he's did, and we've really gone beyond things. And he's very, very proud of the book. He endorsed that last book, and he's like, I'm so proud of you, everything you've done. We took so much of what I took so many of the philosophies that he taught me, and we really improved on it to get a higher winning percentage. I think, most people can't handle mentally losing more than they win. The key is you have to let a profit run. We're at the point where, our winning percentage, it kind of speaks for itself. How we train students is we give you the method, we give you a trading plan, we encourage you to back test, to demo trade, forward test, fine tune it, keep a benchmark of all your trades. this is long before you're going to trade live. You need to be able to demo trade. You need to keep track of those trades. You're going to benchmark using our trading plan. You can tweak the trading plan. You're going to prove to yourself that you can do it and you can be successful long before you're going to risk your money. So that's going to be the key. Anyway, I'm going off on a tangent. Bill said it, that you have to be part of that first generation using nonlinear techniques. Chaos doesn't mean chaos like you think. Chaos is a higher order. And here's proof that I've seen it over the years where the mean reversion traders used to make money. Now they're gone. The macro traders, now they're gone. And now the quant guys, they're gone. Famous headline in Bloomberg, hedge funds report second year of losses. Well, clearly they're using linear technique. They're not using nonlinear techniques. They're not using essentially what we call trading chaos. Okay, they're not breaking the market down into its different patterns. They're not letting the problem that most people have, and you see this wherever you read stories about the market, where people are arguing about what the market's doing. And the problem is they're not letting the market sort itself out. The market tells us which way to trade. Okay, the market gives us the setup. I go on the 15-minute chart, and today coming in, I know even before the market bottomed there, I knew as of yesterday that the majority of patterns were higher in the euro. So I really don't care what anyone else has to say or about all the problems over there. I know the majority of patterns are up. So the market's, something's right? I mean, your 20-day pattern is bullish. Your secondary's been bullish. So something's right. So when the majority of patterns are up, I'm looking for buy signals and the subject. As long as I'm not jumping in front of any numbers. I knew there was you had that German ZEW number at 4 o'clock. I let that get out of the way. I didn't do anything until then. Guess what? It happened to be a bearish number, but the market gave a hammer, and look what happened then. So much for trying to follow linear logic. Oh, it's a negative number. We better get short. Now, if you did, you got kicked in the head multiple times. So you can't use linear logic. You got to trust the market to show you the way, and that's what we do. And these guys didn't, and that's why they're no longer in business, right? So here's how I define trading chaos: employing a method based on fractal geometry, i.e., embracing the understanding that markets are scalable and these scaled patterns are repetitive. Believe what you see, okay? Don't believe what you hear. Don't believe what you read. Believe what you see, okay? If the market is giving you a bullish pattern, right? If the market's bottoming on support and it's in an overall uptrend, okay, your job is to buy dips in an uptrend, right? So if the market is rewarding longs, believe what you see. Find the support level, wait for the trend shift, the counter trend shift in line with the pattern, and go along with it, okay? The pattern absolutely is a reflection of the underlying fundamentals in the market, okay? Here's the secret to trading. Markets are scalable. We just showed you that, how you can measure a market's the different time frames, wait from the line, so they're scalable, and these scaled patterns are repetitive. They're just going to repeat themselves over and over and over. You really saw that on the way down here in the euro. And you'll see it on the way up too, you know. Look at that. Look at it, it's the same pattern over and over again. That same retracement level. See that same zone I create with that 50% and that line, the orange line above it? It's the same zone every time. Look at that. Boom, boom, boom. Boom, boom. I mean, it's just repetition. That's the secret to trading, is repetition. Now, they reverse, guess what? They start repeating the pattern again. So it's just the same thing. We draw that zone. Here you see our zone right there. The purple line and the green line is support. The purple line and the orange line is resistance. Okay, and you have multiple time periods. This is not just this zone. It may be this zone counting too. Like here's a zone. So here's a short-term zone. Here's a longer-term zone. You got to keep track of all of them. It's pretty simple though. It really is. I mean, once you spell it out and you see it, it gets a lot easier. So the secret to trading is that repetition. That's how you're going to make money. That's how you can make a lot of money, the repetition, okay? You have to get in the groove, though. And it takes a little time to do that, too. Our students will tell you that, too, that it's not going to happen overnight for you because you have to change the way you think. Literally, you have to get rid of a lot of bad habits. Don't argue with the market. That's right, Black Cat. Argue with the market. That's a recipe for losing money. Risk tolerance threshold theory. This is very important. I don't want to get too in depth here. Take my word for it. It's important. Really, here's what you came for, though. How can we help to improve your trade selection? Well, I hope some of the things I've said get you pointed in the right direction. Believe what you see. You definitely want to believe what you see, not what you hear or read. Believe the pattern on the chart. Believe that the pattern on the chart is absolutely a reflection of underlying fundamentals in the market. So we're gonna take a page from our mechanical framework and see if that works for you to determine pattern and direction. And that's all mechanical, by the way. What's nice about mechanical is it doesn't change. It's always the same. It's going to work on any market on any time frame. So know when direction is aligned with pattern. You need to know direction before I can. When I say know when direction is aligned with pattern, I need to define direction for you. Direction is technically it's change of direction. You're not, yeah, we're interested in direction, but if I say the market's up now, I also have to go back and show you when that direction changed from down to up. And likewise, I need to go back and show you every time the direction changed from down to up or up to down. And I need to define that for you, right? I need to define for you when the market changes direction. So it's not direction we're interested in, it's actually change of direction. Change of direction is equals a trend line break plus a directional line shift. You may not know what a directional line is. Mr. CC, no, I can't. Yeah, I wish I could just snap my fingers and it was that easy. No, we're not in the business of helping too many people out, Mr. CC. It is a business, and you know what? My partners in the past give me an awful hard time about giving a lot away, and I think there's something to that. But I'd like to help you, but it's not that simple, though. Change of direction equals a trend line break plus a directional line shift. I tell you what, send me their information. I will send them a note, and we'll see if we can do something. How about that? I'll definitely do that, Mr. CC. Thank you. I'll give you my email, and I'll shoot that over there, too, and we'll see if we can do something. In order to know what a change of direction is, you have to know what a directional line shift is. Keep in mind, I'm a trader, too. Believe me, I'm not here to help people out that I'm going to be trading against tomorrow, right? So, I mean, you're either in the club or you're not. You know, no hard feelings, right? But literally, when we risk our money, whether you like it or not, you're taking other people's money. So it's really not in my interest to help everyone out for free, right? I mean, you ask and you shall receive. There's no doubt about it. I mean, we'll make it available for you for free, essentially. So direction line defined as the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. Right? So you have to know what the directional line is and write that down, the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. It's not the high itself. It's the highest closing candle, the low of the highest closing candle. So write that down. Directional line is used if price is closing below the directional line, direction is down. If price is closing above the directional line, direction is up. And you can have that directional line on any time frame. Let me give you a canned example here. Remember I said the low of the highest closing candle? So find the highest closing candle, then mark the low. And then when you close below the low of the highest closing candle and the trend line, that's a change of direction. Likewise, on the bottom here, mark the high of the lowest closing candle, not the lowest candle, lowest closing candle. Mark that high, and when you close above both the trend line and the high of the lowest closing candle, that's the bullish change of direction. Okay, so that's how we define direction. Now, just the price reversal equals trend line shift plus directional line shift. Now, you can take every change of direction and you'll stumble on some big winners. However,
you're only interested in a change of direction when it's aligned with the pattern. Okay. FX trade, yeah, it works on any time frame. I mean, it's by definition it's mechanical, so it'll work on a 1 minute, a 5 minute. Ideally, though, you want to make sure that you're taking that change of direction in line with the pattern. If you go out there and start taking every change of direction, you're going to get in trouble. So this is the definition you need to know. The low of the highest closing candle in an uptrend. The high of the lowest closing candle in a downtrend. Okay? Those are the key levels for it to work. If it's below that line, direction's down. If it's above it, direction's up. You only have one directional line per time frame, too. Okay, so bam, that's it. You get it right there. That reverses. You close above the high of the lowest closing candle and the trend line. Then you have a bullish reversal there. However, you only want to take that. The key is taking that change of direction signal when it's in line with the pattern. Okay, you need to focus on the pattern here. Let me give you an example in the euro on a daily chart. Pattern is very important for us. Here. This is somewhat simple because this is essentially your first lower high, right? Here's your second lower high. This is a change of direction you're interested in. Okay, here's the lower high. Here's your second lower high. So that change of direction right there. Trying to open it up. Here's the highest closing candle. Okay, right there. Put that line there. Let me make it a little thicker so you can see it. That's a daily chart, so we'll go with the yellow. Okay, that's the highest closing candle. So when you close below the highest closing candle and the trend line, that's a change of direction. You definitely know you have a change of direction, and now it's in line with the pattern. So that's telling me I'm probably going to be looking for sell signals going forward. This is a great change of direction right there. That change of direction, I don't like the risk reward. I'm not going to go short here if I got to put that stop all the way up there. But I'm patient. I'll wait to sell a rally. Once the pattern's telling me it's shifting, I'm looking to sell a rally. I am a patient trader. Okay? Imagine this on a 15-minute chart. All that means is I have to wait a couple hours. But this change of direction I love right here. See how that's my low right there. That's the highest closing candle right there. So you take out the trend line and that. Now it's pretty clear that I have a bearish pattern, right? And if I can get short here with my stop there, it's worth it to, if this is my first profit target, right? If I'm going short at 31.53 and I'm going to try to ride it down to whatever that level is right there, that low, 29.95. So my risk is going to be 31.50 with a stop at 32.80, right? Yeah, 32.80 is the stop, 31.50 I'm in at, and my profit target's all the way down at 29.95. So I like that risk reward. Didn't like this risk reward, like that risk reward. That's a good trade to take. That's a change of direction I'm interested in. I'm not necessarily interested in this change of direction. Technically, here's a change of direction, right? Because you closed above the high of the lowest closing candle and a short-term trend line. That trend line is very important too. You took out the trend line. You did a change of direction. Now, I may use that to exit a trend trade, but I'm not interested in going long there because the pattern's still bullish, right? Now, here I have the patterns. Here's the lower, here's the higher low, here's a higher high, here's the lower low. So I get that second lower low. Here's a change of direction I'll be interested in. Right here, that's my lowest closing candle of the down move. So when you close above it there, I'm more interested in that because I like the risk reward on it. I only have to risk it to the low there. And, if I get a 50% retracement essentially of this down move, I'll have plenty of room to make money. That's a bullish change of direction I'm interested in because see the pattern shifted by then. So that'll give you an idea about how we focus on the change of direction. And we were calling for this rally. If you guys checked out our if you checked out our weekly report that we do, we were calling for that rally right there. I'll see if I can give you the information on that. So getting back there, what the most important thing about the change of direction is that it's in line with the pattern. You have a bearish pattern overall, so you're interested in sell signals here. And this chart's over a year old, but look, the pattern hasn't changed. The market went down almost to 120, then it came up to 137, but it's still in that overall band of resistance. Sanjay, we use fib a lot. Basically, we wait till the fib traders get stopped out, and then really our levels they generally have to be a little bit beyond the fib, but we use 50% a lot too. Fibs are great. I mean, there's no doubt about it. That's how you determine pattern. And you know what's nice about pattern is it's a two-way mechanism. Okay, what happens on the lower time frame? See that three impulse moves up, boom, 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 and it replicates it on the higher time frame pattern. So what happens on the lower time frames definitely influenced by the higher time frames, but also what happens the lower time frames can influence the higher time frames also. And really what it comes down to, we're looking for that change of direction in line with the pattern. Right there, right there. Another way of saying that on the trading floor, you're buying dips in an uptrend. We're always looking for a change of direction in line with the pattern. Change of direction in line with the pattern. And this stock market, by the way, stock market's all the way up here now, right? And again, this is a chart that's well over a year old. The pattern in the stocks hasn't changed. Patterns don't change. Rarely do they change. Once the Fed set the course, literally, once the U.S. Fed set the course with QE1 back here, the course was set, and you're not going to deviate. Now, the Japanese are doing the same thing. The Draghi, by the way, will be doing the same thing, too. So it's going to be completely counterintuitive. The euro will go down, but it's not going to go down until the problems are solved. They'll go with euro bonds. My guess is they'll do what George Soros is telling them to do, and then that'll solve things, and then the euro will go down. So it's completely counterintuitive. Once they're past the danger, then the euro will finally go down. But guess what? People who are arguing with the market the whole time, they'll be out of money by then. I love trading chaos. And here's how we use the pattern. Was that one of the guys before was asking, hey, how do I get that? Well, we make our own, but we send it to clients. Kevin, and we use this. Here's how we use it. Then we just buy in dips. And Sanjay, here's your fib numbers. Well, your fib was right in the middle. But you let it go down, stop out the people that they have their stops at 618. They get stopped out, and then the market stabilizes, and then you go long. So when you have all the patterns up, here's what amazes me. You can have all the patterns up, but you'll have people figure out how to lose money going long, right? Because they'll buy a breakout or something. They'll buy it here, and then they'll get stopped out right there. So you have to understand risk tolerance. You have to be prepared to have markets going against you, right? Or just be patient, and then get a very low risk reward setup like that, where you're going in here, your stop is there, you're going to come out of your first contract right at that high. The market's giving you everything. Here's the signal, here's the stop. You better have enough room to justify that stop. So come out of a portion of your trade right at that high. So you're going to exit here on one, and then just let the other one ride. So we use pattern as a trend map. Same story. You have the majority patterns up. If you have the majority patterns up, that means the collective pattern for this market, the euro is bullish, so you're focusing on getting long on a test of the buy zone. And here's scalability and repetition. All you're doing is looking for a change of direction in line with the pattern. Right? When direction shifts in line with pattern, boom, boom, boom. And here, all we're doing here is giving you the big picture. The grand pattern's down. Here's our primary pattern. By the way, this primary pattern is still bearish. It's the same one, even though this chart's over a year old. You're still in the same primary pattern. So you're looking for a shift, change of direction, right? The low of the highest closing candle. So when price closes below the low of the highest closing candle and the trend line, that's a sell signal. And same story here. And that market dropped all the way to 120. So, Kevin, running out of time. But as I told you before, the deal is free. Now, if you want one-on-one mentoring and you want to be involved in the Skype chat group, so you have the community thing going, it's $199 per month. Now, you pay the 20 pips, pay $199 your first month, you get access to everything. Okay, everything. If you don't like it, you opt out. It only costs you 1 month. Now, here's the even better deal. You get it free if you open a live account with us, okay? And you get the same spreads that the dealers give their best clients, okay? You want to open up with FXCM London. You want, what do you call them, those, I forgot the spreads they call them. The spread better spreads where you get the competitive spreads. You want competitive spreads? Fine, you can have them. Forex.com, you get the same spreads with them, 1.7 euro. You get the same spreads with them as you get with us. You get the program for free. So if you're not sure about it, to me, you want to get that one-on-one mentoring, okay? It's a lot there. I mean, it's 20 hours. You get 20 hours of video free here. So if you're not sure, open the live account, get it free, review it, see everything, and by the way, you get everything up front. So there's none of this give you the core concepts, advanced concepts a month later. No, you get everything up front. You get the advanced graduate, even the master's course archives. You can even attend our live courses right away, right out of the gate. We give you everything up front. And if you need the mentoring, that's $199 a month. If you're not sure about it, open an account and you get it free thanks to the brokers. Kevin, you have to open up another account. That's all right. Just go to EOS Trade and go to Getting Started, and you'll see all your choices there. I'll give you the contact information too. Here, let me just open up EOS Trade. Note, I have Bloomberg as my home page, so there's none of that Yahoo nonsense or any distractions. EOS Trade, Getting Started. Pick your broker. Pick your poison. FXDD, futures we have open eCry, and you have to open up with them. So hey, we look forward to meeting you some of that way. Here's our information if you want to find out more about that. Thanks, Kevin. Good seeing you. And again, you get the same spreads as you get through going with the broker, going with the dealer direct, and futures too. We do. Hey, thanks, Drew. Thank you, sir. And we'll be back tomorrow. We'll catch everyone again tomorrow. And there's the site, EOS Trade. Send me, if you want to do something, send me an email directly, because a lot of times I don't get the emails. I don't know if people are opening right away. So if you want to get in the campus right away, I'm the guy that's got to sign you into the campus, and that will get you in free for sure. But I got to know what you're doing, So if you do something, let me know. Send me an email. Okay, thanks, everybody, and we'll catch up with you tomorrow.